Hey everyone, welcome to Tax and Accounting Tips, short video designed to get you a bigger tax refund, protect you from loss, or just give you peace of mind that if the IRS comes knocking at your door, you've done things right. Have you or will you ever be inheriting a traditional IRA? I'm not talking about a Roth IRA today, just going to concentrate on traditional IRAs. Well, in my opinion, this is a really complicated part of the Internal Revenue Code. And quite often we have discussions about this at my office. Most of our discussions have to do with your RMD, or required minimum distribution, after you inherit the IRA. But before I get into that, let's start with the basics. What is a traditional IRA? Well, that's pretty basic. It's an individual retirement account that holds investments. And it got there as a result of the deductions that you took in your tax return when you contributed to it long ago. And then it grew tax-free. And there's one other way it might have gotten there. You might have had a company 401k or some other kind of company pension plan. And when you left your company, you opted to do a tax-free rollover of the pension to your IRA. But company pension plans, no matter what they are, 401ks, SEP plans, simple plans, defined benefit plans, they're all basically the same thing, just like IRAs are. They're all funds that got there because of tax sheltered income in the past. And sooner or later, when you withdraw from the IRA, the magic word is distributed, it's going to get taxed. The deal is you got the benefit of the deduction long ago when you were working, and now you got to pay the piper when you take it out. Now, the government doesn't let you hold off taking the funds out of the IRA forever. They want their tax money, because normally everything that gets distributed from your IRA gets taxed. So they have a rule that says once you're 72 years old, yes, they just upped that from 70 and a half to 72, you must start taking it out, distributing it, based on your life expectancy. So due to that rule, the IRS finally gets their tax money. And as I said before, the amount that you have to distribute each year after you're 72 is called a required minimum distribution, or RMD for short. Now, a word for the wise, don't miss your RMD. There's a very nasty penalty if you miss it. Nothing we can't get you out of, but it's a pain, so don't miss it. How do you figure out how much your RMD is? Well, you just add up the value of all your IRAs on December 31st of the previous year, and you divide that total by a divisor that you find in the IRS table called the IRS Uniform Life Expectancy Table. Go ahead and Google it to get the table. It's easy to use. All you do is find your age on the table, and next to it, it'll tell you how long you have to live. And you know what? For once, you're going to like the IRS. They're actually letting you live a long time. For instance, if you're 74, your life expectancy is another 23.8 years. That means they're letting you live till you're 97.8 years old. Not bad. But they're being generous because they know they're still going to get their tax money even when you die. Because you see, your heirs will get stuck with the RMDs on your IRA when they inherit it. And that's when it gets complicated. How much do you have to start distributing every year if you're the one who inherits it? Well, if you're the surviving spouse that's inheriting it, you get to elect one of two options. Option one, you can just roll it into your IRA if you have one. If not, you can just put your name on it. If you don't, make it yours. If you do this, the normal IRA rules will apply to it, such as the 10% penalty if you're under 59 and a half, and the required minimum distribution on your life if you reach 72. This required minimum distribution will be based on your life. And it's a good deal if you are, say, in your 60s and you want to stop distributing until you're age 72. Take note that you can do that even if your deceased spouse has already started distributing. So putting the inherited IRA in your name is a good thing if your goal is to keep the money growing tax-free as long as you can. But what if your spouse dies and you're under 59 and a half yourself and you need the money? I mentioned before that when you're under 59 and a half, you can't take a distribution from your IRA without paying a nasty 10% penalty with the tax on top of that. So that would be a problem. But in this situation, instead of just taking your deceased spouse IRA as your own, as an option 1, you probably want to do option number 2, which is to do an inherited IRA. The inherited IRA option, even if you're younger than 59 and a half, you can take some or all of it immediately, but at a minimum, you must take the required minimum distribution based on your life expectancy. So even if you're 30 and you want to start distributing it right away, you won't get nailed on an early distribution penalty for taking the money before you're 59 and a half. So the inherited IRA option is a good deal if you're young. Now, there's also another case where the inherited IRA option works well, and that's when you're older than your deceased spouse. That's because they have a special rule, this is only good with the inherited IRA option, that allows you, as a surviving spouse, to wait until the deceased spouse would have been 72 until you have to start taking the RMDs. So it allows you to put off the distributions longer if that's your goal. Well, those are the two options for spouses. And the one that's best for you as a surviving spouse depends on your circumstances. Now, what if you're not a spouse and you inherit an IRA? Well, you can't just step into it and make it the IRA yours like the spouse can. You have one choice, and that is to drain the IRA within 10 years of when you inherit it, no matter how old you are. Now, you can wait 9 years if you want and not distribute anything, and then, just before the 10th year, distribute the whole thing. I wouldn't recommend doing that, but you can do that if you want. That's a new rule that went into effect January 1st, 2020, and it used to be more complicated than that, but that's the rule now. So to sum it up, I just want you to be aware that a surviving spouse can elect one of two options, and a non-spouse needs to distribute the whole thing within 10 years of inheriting. How's that for simplicity? Well, if you like this little tip, please pass it on to one of your friends who might need it, and put in a good word for us. Thanks, and have a great day.